On February 28, 2026, the global energy map was, it was essentially set on fire.
Yeah, it really was.
Welcome to the deep dive. Our mission today is to really connect the dots between a sudden, massive geopolitical explosion in the Middle East and the long-term future of global energy, because those two things are now intimately tied together.
Absolutely. And we are unpacking a phenomenal stack of materials today, all focused on the very recent past, specifically late February and early March of 2026.
Right, and just to give you an overview of what we're looking at, our sources include a rapidly updating Wikipedia page tracking the 2026 Strait of Hormuz crisis, financial projections from Goldman Sachs and Guinness Global Investors, plus some really incredible aviation industry analysis.
From Aerospace Global News, yeah.
Exactly, and geopolitical research from Columbia University's Center on Global Energy Policy. So we have a lot of ground to cover.
It is a fascinating stack. I mean, it takes us from the flaming decks of oil tankers in the Persian Gulf straight into the cooling towers of the server farms powering the next generation of artificial intelligence.
It really does. But before we jump into the timeline, I want to make a really clear, neutral statement for you listening. Given the highly charged nature of these 2026 events, which involve the United States, Israel, Iran, and the Trump administration, our lens today is strictly analytical.
Right. Completely neutral.
We are just looking at the math and the data in these reports. We are not taking any political stances or endorsing any viewpoints. We're simply reporting the facts exactly as they're laid out in the source material so we can understand the structural realities on the ground.
Precisely. We are analyzing the economic domino effect. Just looking at the data exactly as our sources present it, nothing more.
Okay, let's unpack this. So the Wikipedia timeline details an event on February 28 dubbed Operation Epic Fury.
Right.
This was a coordinated United States and Israeli military strike on Iran that resulted in the death of Iran's supreme leader, Ali Khamenei. And almost immediately, Iran launched retaliatory missile strikes on Israeli territory and U.S. military bases scattered across the Gulf.
Which was the spark.
Exactly. But while the air defense systems were working overtime on land, the true economic earthquake was happening in the water.
Yes, specifically in the Strait of Hormuz.
Which is the ultimate choke point.
It is, because the Hormuz bottleneck is only 21 miles wide at its narrowest point. So that 20 million barrels of daily flow is just incredibly vulnerable.
20 million barrels.
Every single day. We are talking about 20% of all the seaborne oil traded globally. Plus a massive chunk of the world's liquefied natural gas, or LNG, mainly coming out of Qatar. It is the central artery of the global fossil fuel economy.
And overnight, that artery was severed. I mean, the Iranian Islamic Revolutionary Guard Corps started broadcasting warnings over VHF radio, explicitly telling commercial vessels to stay out.
And they listened.
Oh, they listened. The impact was staggering to watch unfold in the data. Ship tracking data showed an immediate 70% drop in traffic. And then by March 2nd, the AIS tracking signals, the beacons that ships use, they showed almost zero tanker traffic in the strait. Zero.
It just evaporated.
Yeah. I was reading through the real-world casualties on this Wikipedia timeline, and it translates that raw data into metal, fire, and human lives. The Skylight, which was an oil tanker, was struck, tragically killing 2 Indian crew members.
Yeah, that was awful.
Then the Stena Imperative, a U.S.-flagged products tanker, was hit twice while docked in a port in Bahrain, sparking a fire. And then the Sonangol Namibé suffered a massive explosion while anchored near Kuwait, resulting in an oil spill.
What's fascinating here is the underlying mechanism of the shutdown. Because Iran never formally, legally declared a blockade of the strait.
Which you'd think would matter.
Right. But in the world of global shipping, a legal declaration doesn't really matter at all. The physical threat dictates the maritime insurance premiums.
Ah, the insurance.
Exactly. When drones and missiles are actively hitting commercial hulls, the war risk premiums multiply overnight. They spike to the point where it becomes entirely economically unviable to sail.
So the insurers effectively enforce the blockade without anyone having to declare it.
That's it. When insurers pull their coverage or just price gouge it to the moon, the ships stop moving. The risk became too high, and major global shipping companies, giants like Maersk and Hapag-Lloyd, simply suspended all transits through the area.
They just said, nope, we're not doing it.
They cannot risk a $100 million vessel and its crew just to test the waters.
Which instantly brings us to the economic shockwaves. The price of oil just went vertical. Brent crude jumped 25%, pushing past $90 a barrel. And this wasn't just a blip.
No, not at all.
The Guardian noted that this was the highest weekly gain since the start of the COVID-19 pandemic back in 2020. But the price of oil is just the surface metric. What really caught my eye in these reports is the physical storage crisis.
Yes, the storage crisis is the hidden variable here. It's the thing that aggressively accelerates the timeline of a geopolitical shock. Because if the ships cannot safely leave the Persian Gulf, the producers cannot export. But the oil keeps coming out of the ground. Kuwait actually had to start shutting down production at certain fields because they literally ran out of physical space to store the crude.
They just had nowhere to put it. And shutting down a well isn't like flipping a light switch, right?
Far from it. When you shut in a well, you alter the pressure dynamics of the reservoir deep underground. There is a very real, very terrifying risk for these producers that when you turn it back on, it might never produce at the same rate ever again.
Wow.
It is a massive, long-term economic threat to these petrostates. Kreipler, the commodities consulting firm, ran the numbers and estimated that heavyweights like Saudi Arabia and the UAE could hit their absolute maximum storage limits within 20 days.
Okay, so wait. If Kreppler says Saudi and the UAE hit their storage limits in 20 days, but I am looking at the Goldman Sachs analysis, which calculates that the market is currently pricing in a full 4-week closure of the Strait, aren't those two timelines on a direct collision course?
They're on a massive collision course. Goldman notes the market is currently demanding a $14 risk premium per barrel, which aligns with that theoretical 4-week shutdown. But if physical storage maxes out in less than 3 weeks, the math completely breaks.
Which means the exports don't just delay, they stop.
Exactly. That is why Qatar's energy minister issued such a stark warning. He stated clearly that if this situation continues, all Gulf energy exports could be forced to stop entirely. And he warned we could be looking at oil spiking to $150 a barrel.
And why does this matter to you? If you are listening to this, you might not be trading crude oil futures on your phone, but a spike like that hits your wallet incredibly fast.
It hits everything.
Right. It is the cost of gas at the pump, sure, but it's also the cost of everything that moves on a truck, which drives up broader inflation. And if you have travel plans, the aviation industry is taking a massive direct hit. I was looking at the Aerospace Global News data, and the math here blew my mind.
The compounding costs for airlines right now are just brutal.
Brutal is an understatement. The price of jet fuel in Europe skyrocketed to over $1,259 per metric ton.
Wow.
That is the highest it has been since the start of the Russia-Ukraine war. But it isn't just the base cost of the fuel, it is the sheer volume they are burning to avoid the war zone. They calculated that a single detour from Tokyo to London is adding 90 to 120 minutes of actual flight time.
Just flying around the Middle East.
Yes, just steering clear of the airspace. That detour burns an extra 5,600 gallons of jet fuel. That adds $20,000 in operating costs to just one single flight. Multiply that by thousands of flights, and you see why Indian Airlines have already raised airfares to the Middle East by up to 4-fold.
And this raises a really important question about global resilience. When the global chessboard is this shaken up, how do the biggest players actually survive the bottleneck?
Well, let's look at China, because they import half of all their crude oil and almost a third of their LNG directly from the Middle East.
They are heavily exposed.
Hugely exposed. On paper, a total blockade of the Strait of Hormuz should bring their economy to a grinding halt within a matter of days. But here's where it gets really interesting. Despite this massive reliance, China is surprisingly insulated from this immediate shock.
Because of their preparation.
Exactly. Columbia University's Center on Global Energy Policy highlighted that China has an astonishing 1.39 billion barrels of oil sitting in storage.
That number is just hard to wrap your head around.
It's massive. That is enough to cover 120 days of net imports without a single new drop arriving.
It is a phenomenal strategic buffer. But the mechanics of how China feeds its domestic market during a crisis, it reveals this entire shadow economy. You have to look at their teapot refineries.
The independent ones, right? Not the massive state-owned enterprises.
Correct. These teapots operate on razor-thin profit margins. They do not have the massive financial backing of the state. So to maintain those margins, they historically rely heavily on discounted, internationally sanctioned oil.
Which usually means Iran.
Yes. They have established incredibly complex logistical networks to bring this crude in quietly. And right now, with fresh supply from the Gulf cutoff, these teapot refineries are surviving by tapping into a massive shadow stockpile.
You're talking about the bonded storage.
Yes, the bonded storage. There are an estimated 46 million barrels of Iranian oil currently sitting in floating storage on ships out in Asia, or in bonded storage waiting in Chinese ports.
And what does bonded mean in this context?
It means this oil hasn't cleared customs yet. It is essentially in legal limbo, but physically it is right there. It acts as a critical lifeline that keeps their domestic fuel production running, which means they don't have to panic buy on the open market at $90 a barrel.
But relying on sanctioned oil sitting in port isn't a long-term strategy for a superpower. And the Columbia University research outlines how this specific crisis might fundamentally alter global infrastructure over the next decade.
Absolutely. The geopolitical vulnerability of maritime shipping is driving China to severely accelerate land-based alternatives.
Yeah.
The research suggests this Hormuz crisis might push China to rely much more heavily on the proposed Power of Siberia 2 pipeline, which would pipe natural gas directly from Russia.
Because you can't block a pipeline with the submarine.
Exactly. A land-based pipeline completely bypasses maritime choke points like the Strait of Hormuz. It is a critical piece of China's broader drive for absolute energy self-sufficiency. They are watching the Gulf burn right now, and they are accelerating routes that cannot be blockaded by a carrier strike group or a swarm of drums.
Which creates an incredible organic bridge to the other half of our source material today. Because while China looks for safer pipelines, Western tech companies are watching this extreme oil volatility and realizing a terrifying truth about their own infrastructure.
That they're completely exposed.
Totally exposed. They are trying to build out the future of computing, and they cannot tie that future to an energy grid held hostage by a 21-mile bottleneck in the Middle East.
That is the core structural shift outlined in the Guinness Global Investors Report. We are looking at a massive secular shift happening right underneath all this geopolitical chaos.
It's the electrification trend.
Yes. The years 2025 and 2026 have been defined globally by the electrification of everything.
Right. And we were talking about electric vehicles, heavy industry transitioning off gas, heat pumps going into residential homes. All of that draws massive power. But the wild card, the massive new driver that is completely upending the power grid, is artificial intelligence.
The logistical hurdles of building these AI data centers are just staggering. I mean, to put it in perspective, a traditional data center might draw 50 megawatts of power.
Which is already a lot.
It's a lot.
Yeah.
But the new training clusters required for next-generation AI, they're demanding 500 megawatts, sometimes a full gigawatt of power.
A gigawatt?
Yes. That is the power consumption of a small city concentrated into a single warehouse. In the U.S. alone, the power demand from AI data centers is projected to jump from between 4 and 5% of the total grid, all the way to 12% by 2030.
And the Guinness report notes that the forecast for the U.S. annual incremental power demand has grown 8 times over since 2021. 8 times. The legacy grid was absolutely not built to handle that kind of localized, extreme power draw.
Not even close.
You need massive upgrades to transformers, high-voltage transmission lines, and generation capacity. And you need it fast.
Which brings us to the policy environment that actually dictates how fast that grid can be built. Looking at the Guinness report, we see how the U.S. political landscape navigated this infrastructure bottleneck. Now, President Trump replaced the previous administration's Inflation Reduction Act with a new legislative package called the One Big Beautiful Bill Act, or OBBBA.
Right. And keeping our purely analytical lens here, just reporting on the policy changes, this new legislation did cut certain tax credits for electric vehicles and residential solar. But crucially, it retained the manufacturing credits through 2032.
And that detail is everything. That retention of manufacturing credits through 2032 acted as a massive clearing event for the industry.
What does a clearing event mean in this context?
It means before this bill passed, capital was just sitting on the sidelines. When policy is uncertain, developers cannot finalize their spreadsheet math, so the funding freezes. Nobody wants to build a billion-dollar factory if tax incentives might vanish next year.
Makes sense.
But even though OBBA altered the broader incentive structure, locking in those specific manufacturing credits for 6 full years provided absolute regulatory certainty. Developers finally knew what the playing field looked like, and it unleashed billions in sideline capital, allowing them to accelerate the massive grid upgrades required to win the global AI arms race.
If we connect this to the bigger picture, the underlying economics of energy are shifting entirely independently of the politics.
Yes.
And this is perhaps the most staggering statistic in the entire Guinness report. Renewables are simply winning the baseline economic argument. Recent wind and solar projects are commissioning at costs between 3 and 11 cents per kilowatt hour.
That's incredibly cheap.
It's basically free compared to the alternatives. Because meanwhile, new fossil fuel generation is costing between 8 and 17 cents per kilowatt hour. Wind and solar are literally the cheapest form of new electricity generation on the planet right now.
And the capital is strictly following that math. Global clean tech investment hit $2.2 trillion in 2025.
$2.2 trillion.
Yes, that is double the amount spent on fossil fuels globally. Tech companies are desperate to power these gigawatt AI data centers, and they need predictable, stable energy costs. Building a new nuclear plant takes a decade or more.
Way too slow.
Exactly. And building a new natural gas plant exposes them to the exact kind of supply chain delays and geopolitical price shocks we're seeing right now in the Strait of Hormuz. But clean energy, particularly utility-scale solar, combined with massive battery storage, is now the fastest and cheapest way to get new power onto the grid.
So what does this all mean? When we look at all these sources together, we are looking at a stark real-time contrast. On one side, you have the absolute geopolitical volatility of fossil fuels. You literally have missiles flying over the Strait of Hormuz, shutting down 20% of global oil, forcing airlines to burn thousands of extra gallons of fuel, and sending global inflation fears through the roof.
It's chaos.
Complete chaos. But on the other side, you have the falling costs and domestic security of renewable grids. And it is not just the generation. Battery tech is plummeting in price, and it's expected to drop below $100 per kilowatt hour this year in 2026.
Which is a critical threshold, because that $100 mark is widely considered the magic number where electric vehicles achieve upfront cost parity with traditional internal combustion engine cars.
Meaning they just become the default cheaper option on the lot.
Exactly. So to summarize what we are seeing across the Wikipedia data, the aviation reports, and the investment forecasts, we are witnessing a real-time collision.
A collision of eras.
Yes, it is an old-world energy crisis in the Persian Gulf crashing head-on into a new-world energy boom. And that boom is being driven by the insatiable demands of AI, the broader push for electrification, and massive trillion-dollar grid investments happening simultaneously in the U.S., Europe, and China.
So whether you are trying to buy a plane ticket for next week and groaning at the $20,000 in extra fuel costs being passed down to you, or you are watching this wild AI computing boom unfold over the next decade, these two massive forces, geopolitics and electrification, are actively shaping your daily life.
The vulnerabilities of the old system are directly accelerating the investments in the new one. When the old system breaks down this spectacularly, it forces capital to look for more secure, predictable alternatives.
Which leaves us with a final thought for you to mull over. We have seen how Western tech giants and major powers like China are actively insulating themselves. They're buying up renewable capacity and securing massive, independent grid upgrades to fuel their AI ambitions.
Right.
But if the world's wealthiest players effectively monopolize the supply chains for clean energy and battery storage, does that leave developing nations with no choice but to rely on the very sanctioned, highly volatile oil that the West is aggressively leaving behind?
That's the real question.
It is a structural divide that could redefine global inequality for the next century. Just something to think about. Thanks for joining us on this deep dive into the source material. We will catch you next time.